doesn't fit all personalities, obviously.
Hey, it's Walter here, and you're at the Think Profit podcast, where we're going to help you develop a rock-solid trading confidence and avoid the potentially endless cycle of system switching. Right, Hugh?
That's right. We're going to help you develop a wealth mindset, develop a trading strategy that fits your core personality, and help you overcome the obstacles that stop over 90% of traders.
All right, Hugh, sounds good. You ready to go?
Yeah, let's do this.
Hey, Walter, I want to get your opinion on this. Do you think you should take out a loan to trade?
No. I don't think so. No, I wouldn't do that. I think you're better off. Think about it this way. Let's just say that you're not a trader. So we're talking about active trading, right? You and I, that's what we're talking about here. All right, let's I always like to do this, like make something extreme. Okay. What if you were a investor? Okay. So you're not a trader. So like if you take something and you move it across the spectrum to the other side. So day trader is here, a person who takes like 10 trades a day or 20 trades a day. And on the other end, we have like Warren Buffett style, investor who just sinks money into something and holds on to it for years, right? And then eventually gets out, maybe not. I don't know if he's ever sold his McDonald's shares. I don't know, but I think Warren Buffett owns a lot of McDonald's shares. Anyway, so let's think about that. Is it a good idea for me as a trader to get a loan? Well, if I were an investor, would I go out and get a loan so I could sink all of my loan money into like Tesla stock or something, because I thought 10 years from now Tesla is going to be way higher than it is now, so I should do that? And most people would tell you no, right? That's probably not a good idea. You know, like especially if your loan rate is variable or whatever. A lot of countries, it's not going to be fixed. So you never know where interest rates are going to be, right? And, that sort of thing. So that there's that, and you don't know what the markets are going to do. Are you going to be able to service that loan, that sort of thing? I think you're much better off doing like the dollar cost averaging thing, right? Where you just make a little bit of money this month and sink that into, buying a few shares or whatever. And the same thing with trading. You can just take a little bit of money, put that into your trading account, assuming you've done all your testing, assuming you've done your back testing, assuming you have some strategies that you like and you want to try them out. The accounts now can be like, you can get accounts with like $50, right? Like you can trade micro cents. So like, it's really easy to get your feet wet and actually start implementing your strategies without, you know what I mean? Without, taking a loan out. So it's really tempting. And I understand why people want to do that. And they think that they should. I think you're better off if you're actually that good. Just go to one of the prop firms. That's essentially what you're doing, right? Like they're loaning you their capital and then they're somehow splitting the profits. And so if that's what you want to do, you're better off doing that. And there are some, I think, that are pretty low, and like the fees are pretty low. I don't know. I've seen a lot of them. There's a lot of new ones out there now, and I didn't realize it was that big. But some of my students have been telling me that they're trying to qualify or whatever. So I've looked into it, and I'm like, wow, there's actually some pretty good ones. So you could do that. You could just trade on demo, save your money up every month until you have enough to like put that fee toward the prop firm that you want to qualify for. Now, let's say that takes 5 months. Well, let's see, did your demo account that you were trading, would that have qualified, right? That's another thing you can do. So you're trading on demo. Do you qualify in the 30-day or 60-day period or whatever it is with the prop firm by the time you get enough money up to pay the fee or whatever, right? So that's what I would do. I would do something like that, because that gives you a more realistic, okay, then okay, well, I didn't qualify with my demo account, and here I am. I've got the money. Do I really want to do this sort of thing, right? Or I qualified in 35 days. It was no problem. I've got the money. I'm confident now, and then let's do it, right? So I think you're better off going the prop firm route than trying to get a loan or something. I would either dollar cost average and add a little bit to my account every month or every week or whatever, or I would probably go demo plus prop firm and see if I can get up to speed that way. Yeah. What are your thoughts?
Yeah, I agree. I think that's probably the best way to do it, because you're not actually on the hook for the money. You're just using their money, right? And if you lose it, that's their money. You probably won't get hired again, but you didn't lose your own money. Another thing I think you could do is look at more aggressive trading strategies, right? Like stuff that will multiply accounts quickly. And obviously you have to account for the fact that you'll probably blow out a few accounts. But at the same time, you take a small account like $500 or whatever, or even like $100, and maybe you turn that into 500 or 1,000 or whatever it is. And then from there, you can kind of build your stake and then reduce the risk or whatever. I mean, it doesn't fit all personalities, obviously, but it's definitely an option also.
Yeah, absolutely. Let's say you start with $1,000 or $800 or whatever, and then you work that up to 10. You can pull the $1,000 out or $2,000 out. So now you're at 8. And like you say, you could split it too. So you could go, okay, I've got 1,000. I work it up to 10. Now what I can do is take 2 out, right? Put that aside. That's just in case I blow things up. Okay, I've got another 2 that I can start later. Now you go, all right, I've got 8. So that's 4 different accounts, right? Mm-hmm. So I could have this strategy A in this account, strategy B in this account with like medium risk, and then I could have strategy A and strategy B with like high risk, right? So you can spread it out that way. And I always say do different brokers too, because like the worst thing that can happen is when you lose your money because of no fault of your own, but because your broker goes bad on you. So especially when you're trading like high leverage like that with like little accounts, you want to spread it out so that you don't have a lot of broker risk. You want to have multiple brokers, and there are plenty of brokers out there that will give you high leverage. So you know,
yeah, even if you're in the US.
Yeah.
Okay, cool. Thanks, Walter.
Thanks.
All information in this podcast is for educational and informational purposes only and is not trading or investment advice.